Hi everyone, I'm Jared of Lone Street, and you're tuned in to propertyinsight.com.my. When selecting a property loan, there are a number of factors to consider. The most obvious ones, of course, would be your interest rates, whether you want fixed interest rate or floating interest rates, and of course, what is the interest rate itself. But there are other things to consider. For example, if you want a fully flexi loan or maybe only a semi-flexi loan, it all comes back down to what suits you. Then there are of course things like how long the bank can finance your loan. For example, some banks can do anything from 30 to 40 years, or some banks even going up to age of 75, while most banks are only from 65 to 70. So it comes back down to suitability to what you need. And then of course there are terms and conditions like the exit penalties, which are very important, because if you are locked in, you probably cannot sell within a certain number of years, or you incur exit penalties anything from 2% to 3.5%. And other terms and conditions like fees, charges, and so those are the factors that one must consider. The one thing about getting a property loan for a purchase or even refinance for that matter is that banks may value a property differently from how you value it or how the vendor valued it. So one of the common difficulties to getting a loan that is suitable to you is that valuations cannot match up to your purchase price or to the amount that you want. And this means that there will be more cash outlay for the investor or the property buyer. The eligibility calculation for homeowners or for loan applicants comes into two steps. The first step will be done, it's what you call basic filtering and screening, and it comes back down to your debt servicing ratio, meaning how much you're paying for all your existing monthly commitments on top of your new loan over your net income. And net income can be derived from your salaries, your businesses, your rental incomes and whatnot, which has to be substantiated, documented with documents, of course. Then the second part of the loan, what you call the loan eligibility, will come back down to the credit approval process, which is based on a bank's credit scoring of a person. So a lot of them use the scorecard approach. They've got different scorecards. So things like whether you have a degree, how old you are, of course, still how much your income is versus your existing commitments, even things like your CCRIS, which is your repayment history, and your CTOS, which is do you have any legal actions against you. All this plays into the scorecard. And so at the first stage, you've got the basic screening, and on the second stage, the credit approval process. All these factor into a person's eligibility. One thing about income, how banks derive income, is that everything has to be supported with documentation now. Specific to investors who lease out their properties or rent it out, for you to prove rental income, you have to have two things. Number one, you must have a signed and stamped tenancy agreement. And number two, you must have the money going into a bank account. So your bank account statements must show a consistent pattern of people paying their rental. Now, one of the very common mistakes, or the few very common mistakes that people do that causes them not to be able to use their rental income for their DSR calculations is, number one, either they don't have tenancy agreements, or they have tenancy agreements but they do not send it for stamping, or number two, they have tenancy agreements, but they receive the payments in cash, which they do not put into a bank account on a consistent basis. So if either one of these two are not fulfilled, banks cannot use the rental income as a basis for supplementing a person's income. Now, some people have asked how they can go about getting more than 90% financing. Now, there are, of course, the acceptable ways, and then there are the frowned upon ways. Now, the acceptable ways are, most of the time, if you go for a residential property financing, you can't get anything more than 90% of the purchase price or the value of the property. But if you start to finance in your MRTAs, you start to finance in your entry costs like your legal fees, then some banks will give you a 90 plus 5 package. So that's totally possible. And then there are market practices, which by the way we are not involved in and we do not endorse, where people collude with the property vendor, the seller. And for example, a property is sold to a person for $600,000, but the buyer, being confident he can get a higher valuation for a property, convinces the seller to write or to put inside the sale and purchase agreement as maybe $700,000. And when they go and apply for a loan, they will apply for 90% on that $700,000. If the bank can accede or they can agree to that kind of valuations, voila, what happens is the loan is approved on an amount higher than the original purchase price, and there you got it. You got something more than 90%, but this very much depends on collusion with the vendor, which is the seller, the purchaser, and the people doing the valuations of those. So there is risks involved, but and while we do not endorse it, we do know that in our experience it does happen.